Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Chicago, Illinois. Welcome to the show, Joel Friedland.
Thank you, Victor. You know that I am a big fan of yours.
Well, thank you. That's great to hear. I love that. Well, Joel, you've been at this game a while. You're in the realm of industrial and you come at it from a different angle. I'm really excited to have this conversation because what you're doing is different, even if nothing else in terms of deal structure, which is super important. But maybe before we dive into the details, perhaps give a little bit of your backstory and how you got to this point in your journey.
Sure. So I'm 66. And when I was 22, I went to work for a family, not my family, a father, two sons, and a daughter. They had 84 industrial buildings, and they taught me the business, and they were exceptional mentors. I was there for 10 years. They declined to adopt me. So I decided to go start my own business with a group of other industrial people, and we built a brokerage company that was also an acquisition business and a syndication company. And so I've been doing this for 44 years, and I went through 2008. I had 50 buildings, and if you know the Rod Cleef story, I was just like Rod. I had a difficult period of time in 2008. I had $70 million in guarantees and 7 banks, and banks have no sense of humor. And I went through a very, very difficult period, depression, anxiety, struggling, nearly killed my wife because she had to see this every day. And it took me a while, but after deciding that I wanted to be in the business, I had to do it a different way for my mental health. I decided to do only debt-free deals, 0 mortgages. Most of the time, 1 out of every 4 deals that we do, we'll put a small mortgage, and our maximum is 30% loan to value, which is not a lot. I don't like those deals as much as I like the debt-free. And we're syndicators. So what we do is we raise a lot of money from a lot of people because it's 3 times harder if you've got 0 debt versus 30% down on a 70% loan. So what we've done is we've assembled a group of like-minded investors who are totally risk averse. They just have no interest in losing any money, and they agree with my philosophy that you don't have to have a mortgage, even though almost everyone in real estate thinks you do. And I don't know if you know this, I think there's 4,000 syndicators in the United States. That doesn't include Canada. And of those 4,000, I don't think 3 do debt-free, and it may not even be 3. It may just be 2. I've only found one other one, and I've heard of another one.
Wow.
So we're different.
Very different. And I love that because, well, like you said, it is harder. I mean, leverage has its advantages, but it is a double-edged sword, as you experienced. And so at what point does leverage give you better metrics in terms of rates of return and gets you a better multiplier on your cash, but it doesn't come without some risk? And so then the question is, at what point is that risk? Well, everyone's risk threshold is different. If an asset is trading in the marketplace, let's say at a 5% cap rate, over the last couple of years, you would probably hear this from investors. Why would I put 5% with you when I can go get 5% in T-bills and take no risk at all? Now, granted, the dollar is probably not going to go up in value. That's a safe bet, whereas the building still might. But so that's one distinct difference that distinguishes a T-bill from a cash flowing industrial property. But so then the question is finding those investors for whom that appetite exists at those lower yields.
Yeah, it starts with the deal. It always starts with the deal. I've heard you say that. I know it does. And I agree with you. We only buy single tenant freestanding buildings. And we also only buy buildings under 30,000 square feet. So we do it for a reason. The reason is because in Chicago's the second largest industrial market in the country. And it's similar to Toronto, if you want to compare it to Canada at all. It's a very large industrial market. And they're not building any new buildings under 30,000 square feet. In fact, there's a loss of square footage because a lot of data center developers are buying industrial buildings near where there's a lot of electric power, and they're tearing down industrial buildings. In Chicago, we have 16,000 industrial buildings, Now, you would think if there's 16,000, maybe they're building some new ones under 30,000 square feet. And the answer is zero, none. So it's not like the problems that they had in Nashville and in Austin where it was overbuilt. They're not building our kind of product. So we have a different approach, which is limited supply. The demand is extremely high for freestanding buildings to purchase. And our job is to cold call in industrial parks and to get there before the users get there to pay a user price. We buy from an investor. Usually it's the family that owns the business in the building, and they've sold the business to a private equity group, and now they want to get rid of the building. And it's often because brothers and sisters who inherited the business want to get rid of each other.
Right.
That's common. There's the 4 Ds: divorce, disagreement, death, and dissolution of the business. So, or divestiture of the business. So the Ds are what drive it. And we have to find people who are doing one of the Ds in order to get the good deal. Once we get it, we put it out to our investors and they flock in. Unfortunately, when we do a big deal, we don't have enough investors. A small one, we have too many. So it's never a perfect fit.
There's another segment of the market, which is the small bay industrial, often multi-tenant, where there's also not building any of that new product in the marketplace either. And it seems like in a multi-tenant scenario, the only thing that's getting built is mid-bay or the very large 200,000 to 400,000 square foot plus is what's being built. And we see a lot of it, a lot of spec construction in, for example, Dallas, where there's that's just a massive market. My perception, you can correct me if I'm wrong, is that there's not a ton of it being built in Chicago, even though it is a large market.
There is none of it being built in Chicago. There's no little units. And the word small bay, or whatever the word is with a bay, we never even heard of that before about 2 years ago.
Right.
We don't do any multi-tenant. We only do single tenant. And the reason is because a single tenant building has a user exit. We have not sold anything on a cap rate. Out of 82 buildings that we've sold, we've only sold 4 on a cap rate, and that was in 2006. So we only sell to users. We usually sell to a neighbor. So what happens is our tenant leaves. We try to replace them. Well, the first thing we do is we try to renew the lease. If we can renew the lease, we keep the building. But if we can't renew the lease, we put it on the market. We hire a broker. And if we find a tenant, we grab it. And if we don't find a tenant, we sell it. And our sale price a user sale price is usually at about a 40% premium to a cap rate sale. So it's funny, investors who don't know this, when they first get in touch with me, they say, I'm worried that the building might go vacant. And I say, God help us if it doesn't go vacant. If it doesn't go vacant, we can't get the 40% premium. So we really like when they go vacant and we get a new tenant at a higher rent, or we sell the building. So we bought a building last year for $1.5 million. It was 10,000 square feet. So it was about $150 a square foot. The building's worth absolutely for sure $220 a square foot. Not to an investor, because we buy for what I would call a 7% yield. Our investors have no appetite for anything less than 7% yield. But if we release it, we might get an 8% yield because we might get a higher rent than the current tenant. Because it's hard to beef your tenant up once they're used to paying a lower rent. We have a dog trainer. She's paying $7.50 a foot. And we told her, your lease is coming up. You're going to have to pay $9. And she said, I can't afford $9. A new tenant might pay $10. But if we sold the building, if you think about it, a 10 might be worth $130 based on a cap rate.
Yep.
But it's worth $200 on a user sale.
But that's interesting. So why, in that environment, why would an owner ever own a building? Why wouldn't they always do a sale leaseback? It would be cheaper.
Everybody's got different needs. I'll tell you, a lot of people say, hey, I don't want to piss my money away in rent. Our buildings are big enough that they're real companies that make money.
Yeah.
They make high 6 figures or 7 figures of profit, or they're big corporations. And by the way, the big corporations never want to own, ever.
Right.
I've got AT&T, I've got the Postal Service, we've had General Motors. None of them ever want to own. The only people who want to own are entrepreneurs who are rich. They say, hey, I can own my building and not piss it away to some other landlord. That's what we bank on, is that those users will pay anything because the building is a tool for their business. It's not an investment.
And then presumably by owning it, it gives them access to things like bonus depreciation and things like that they wouldn't otherwise get.
Yes.
A leased scenario.
Yeah. If I have a 20,000 square foot building in a town here called Elmhurst, which is right near O'Hare Airport. So I have 3 buildings there. If I put my 20,000 foot building on the market there, if I had a tenant, it would sell for 120. If I had no tenant, it would sell for 200. So these investors say, I'm worried it's going to be vacant. And I say, honestly, that's what you want if you want to make a lot of money. But I'm going to take the lease first, just so you know. If you invest with us, I'd rather keep it because it's still worth 200. I don't just sell it to prove that it's worth 200. I'd rather keep it and rent it and make my 7 or 8% and send you your distribution than sell it and not have the building anymore. I've sold 82 buildings, and I can tell you that I drive by at least 80 of them. They're all here in Chicago. I've driven by all of them after selling them, and I regret every sale.
Wow.
Yeah.
Fascinating.
Yeah.
Well, Joel, if folks want to connect, if they want to learn more, what's the best way?
Our company is Brit Properties, BRIT with 1 T, properties.com.
Awesome. Well, Joel, great to catch up. And for the listeners at home, you definitely want to connect with Joel Friedland at BritProperties.com. The link will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.